Before we dive in, just a quick but super important reminder. This is all for educational purposes. It is not financial advice. All right, welcome back. Today we're taking our daily look at DexFi for January 2nd, 2026. After that huge run-up to start the new year, the big question on everyone's mind is, can we hold it? Well, today's story is all about stability. Let's get into it. So here's the number that matters most right now. $1,644,150. That's the current value of the fund. And to be super clear, that's not just some random number for today. That is the peak value the fund has seen in the last 23 days, a high we first tagged on New Year's Day. And this is the punchline. This is the whole story for today. We are holding it. You know, the excitement of the big surge is one thing, but now we're in the phase that really tests the health of a protocol, consolidation. And so far, it's textbook. Okay, so to really understand why this is such a healthy sign, we've got to look under the hood at the core metrics. Think of these as the protocol's vital signs. They tell us a lot about this new phase of stability. And as you can see, it's just a sea of green. The fund value is parked right at that 23-day high. Total bonds still climbing, which shows people are still coming in. The bond price is stable, which is absolutely crucial. And the APR is holding firm at a very sustainable 27.31%. This isn't a dashboard of wild speculative growth. It's a dashboard of strength and control. Now, to really appreciate where we are today, we kind of have to look at the journey that got us here. So let's zoom out and look at the whole 23-day story. What's so interesting here is that this tells a classic three-act story. We had Act 1. A slow, kind of steady decline into the Christmas holiday, a time of low volume and general market uncertainty. Then Act 2. From that Christmas low, a really powerful one-week recovery, a surge over 5%. And now we're in Act 3, consolidating those gains at the new peak. This right here is a perfect illustration of the protocol's resilience. It didn't just survive that holiday dip, it actually got stronger because of it. Like the quote says, when prices dipped, volumes surged. When uncertainty crept in, demand for bonds actually sped up. In other words, the system got stronger because of the stress. Okay, let's move to our next key indicator, trading volume. After hitting a record high, we're now seeing what we call a normalization, and I'm going to explain why that's actually a very good thing. So, on December 29th, we saw that massive record-breaking volume of nearly $17 million. It was incredible, but let's be honest, it's not sustainable. And as you can see, volume has since settled right back down to a more typical level of around 7.9 million. Now, I know what you're thinking. A 53% drop from the record might sound a little alarming, but context is absolutely everything here. Look at the right side. Today's volume is only 9% below the healthy 23-day average. We are right where we should be. So the crucial takeaway here is this. This is not a collapse in interest. It's the market catching its breath. It's a return to a sustainable, healthy baseline after an all-out sprint. This is actually a sign of maturity. So, while volume finds its new normal, the demand for Bernard bonds, which is the very foundation of this whole thing, it just remains remarkably consistent. Let's look at those numbers. Think about this for a second. Over the entire 23-day period we're looking at, through the dip, through the recovery, investors still minted nearly 1,900 new bonds. That is a powerful and steady inflow of new capital, no matter what the market was doing. And the key word here is consistency. We're talking an average of 82 new bonds every single day. That translates to over $120,000 in fresh capital. And even during that quiet holiday week, that pace barely slowed down. This isn't just a number. It is the very engine that powers this protocol. Okay, next up is the wallet. We're seeing a higher than usual balance in there, and I want to tackle that head on and explain why it's actually a strategic advantage right now. So you might be looking at this number and asking the right question. Why is over 8% of the entire fund just sitting in the wallet instead of being deployed and earning yield? It's a fair question. Well, first, let's see what's actually in there. It's almost entirely ETH, over $133,000 worth. So this isn't some random collection of assets. This is accumulated profit from trading fees. So here's the why. Remember that record volume we just talked about? Well, it generated a massive wave of fees that landed directly in this wallet. This cash pile isn't idle money. It's a direct result of recent success. And now, it's basically a war chest, ready to be deployed into new positions at exactly the right moment, without having to sell off existing assets. This is a true position of strength. All right, so let's bring all these data points together and land the plane with our final health verdict for January 2nd.
First up, let's just quickly check the chain distribution. As you can see, it remains incredibly stable, which is exactly what we want to see for foundational health. Base is still our dominant yield generator at 89%. This just shows the multi-chain strategy is working as designed, giving us diversification while keeping our core strong.
So let's run down that final health checklist. Fund value, stable at its 23-day high, check. Volume, normalizing in a perfectly healthy way, check. Bond demand, strong and sustained, check. APR, rock solid, check. The only thing we're really keeping an eye on is that strategic wallet balance, which we expect to see get put to work pretty soon. All of this leads to a really clear and confident verdict for today. The protocol is healthy. It's officially in a consolidation phase. And you gotta remember, holding your gains is just as important as making them, and that's exactly what we're seeing right now.
So let's end with this. That New Year surge is consolidating, and that's exactly what you want to see. The fund is holding at its highs, volume is settling back to sustainable levels, and bonds are still minting. Day 2 of 2026 is a very solid, very green day for DexFi.
And as always, just a final reminder, this is not financial advice. Please never invest more than you're willing to lose, and always do your own research before making any financial decisions.